Hi, good afternoon again to our friends from the media. So we are now in our second round of press conference for today. So we have with us two very important speakers. First is Mr. Laboul, Deputy Director for the Directorate for Financial and Enterprise Affairs of the OECD, and Ms. Kyte, Vice President and Special Envoy for Climate Change for the World Bank. So our speakers will be talking about subject matters that are related to the pillars of the Cebu Action Plan, particularly infrastructure development and resilience. Of course, when we talk about infrastructure development, we cannot help but also discuss the topic of long-term investments, which will be expounded on by Mr. Andre. Because as we know, the nature of infrastructure projects, they have a long gestation period, so it is crucial to boost long-term financing. And then Ms. Kyte will be talking about public-private collaboration, such as in the area of disaster risk financing, which is very much related to the pillar of resilience. So we are going to ask our speakers to briefly give us an opening statement, and then, as usual, we will open the floor to Q&A. So may I ask Mr. Andre to give us an opening statement?
Yes, hello everybody. Happy to meet you today. Very briefly, as you may know, the long-term investment and infrastructure are really priorities for the APEC, not only the APEC, but also the G20. And I will explain you a little bit further about these issues. You won't be surprised when this will be made public that the Cebu Action Plan is referring quite extensively to these issues. This is, I think, a very important plan that the Philippine presidency succeeded to put on the table and to get an agreement by the members of the APEC. So I think that we, the OECD, would wish to congratulate the Philippines for this initiative. As I just said, these issues are also very high on the G20 agenda. In fact, the G20 finance minister and central bank governors met last week, so that's really interesting timing to discuss these issues. And concerning the G20 countries, and my intervention today as the deputy was focusing on these issues. The G20 took the initiative to survey the member, survey the investment strategies. And there are interesting lessons from this survey. This survey will be the analysis of this survey will be transmitted to the G20 leaders in November, and the OECD has been mandated to provide a publication, which will be made available in 2 months' time. But there are already some interesting results. The first one is to be fully aware that the investment strategies by countries vary quite a lot from country to country. Just to give you 2 numbers, for instance, the investment ratio to GDP within G20 countries vary from 17% to 46%. And you may guess who is the 46% country. Most of the countries saw an increase of this ratio, but not all. And some countries observed a decrease from 2014 to 2018, which can be explained for legitimate reason. For instance, one country disinvest from a sector and saw a decrease of 3.4, this is huge, % of this ratio. So a lot of variety between the importance of the investment and also the approach taken by the countries. But we can observe that most of the countries now first recognize that the priority should be on quality investment. This is key. Not investment for investment, but quality investment based on cost-benefit analysis. Also to promote the role of the private sector. And as you may know, I mean, the traditional channel do not respond as they did in the past, for instance, the banking one. So policymakers are turning to institutional investors, for instance. And institutional investors have a quite huge appetite for investing in this long-term investment that infrastructure is. But a recent survey by the OECD demonstrated that for the biggest pension fund, in fact, in the world, that on average, they do only invest less than 1% on infrastructure, the direct investment. So this is not a lot. This is on average, I insist, because, for instance, countries like Canada or Australia, which has completely different pension scheme, see in their country pension funds investing quite a lot more. And this is explained by a lot of obstacles. One of the first obstacles for the private sector is the regulatory uncertainty. So they do not invest in a country where they're not sure that the regulation will stay the same. There's also issues related to the skill of the pension fund. So there's a lot of factors which are explaining these kind of issues. And these factors, I mean, these obstacles are addressed by the countries, by the APEC countries, by the G20 countries, to try to have more predictability in the regulation, to also address the administrative burden. And there are interesting also observations, such as the fact that the bureaucracy is conducive to informality. And you know that informality is a quite big issue. And so that's something also which need to be addressed in both ways. Quite often when G20 and APEC countries are discussing issues, long-term investment infrastructure, they also discuss in a correlated way the SME issues, and all the countries have special program on SME, and try also to provide incentive for the SME financing, especially addressing issues like the fact that, as you may know, some startups do not have collateral. So if they don't have collateral, they have a problem getting funding. So these issues are issues which are progressively addressed through special mechanism and approach. So maybe I should stop here, and I'm ready to respond to any question you may have, of course.
Okay, may we ask Ms. Rachel Kyte to give a brief opening statement?
Thank you. So my comments are on a different but related issue, which is the resilience that needs to be built into economies in order to support the growth and prosperity that countries want to see, in particular in this gathering, APEC countries, APEC economies. In order to be able to sustain that prosperity and that growth, then we have to be able to invest in the resilience that is necessary in order to withstand the shocks that will come from the climate change, which we have already condemned ourselves to because of the emissions that we've put into the atmosphere over the last 20 to 30 years. So even with aggressive climate action, and we in the World Bank Group, together with certainly the Philippine government and many others, wish to see a very aggressive climate agreement in December in Paris. Even with an aggressive climate agreement, we will need to invest in resilience in the years to come. What does that mean? It means that economies need to, in particular, improve their financial resilience. And I'll come back to that. Secondly, they must climate-proof their own development spending and the spending in their own economies using international development assistance, which means that understanding risks from climate and disasters, and making sure that the development projects, the infrastructure that will be built can be built to withstand a new normal of volatile weather will be very important. Thirdly, that economies understand that the costs of resilience are going to, in some cases, increase the cost of development, and that all of the evidence, all of the scientific evidence would show that investing in resilience is going to produce a good return on investment, because to simply build infrastructure for weather patterns which are of the past and not of the future will prove to be ineffective in terms of development, jobs, economic growth, and prosperity. This pertains to the private sector as well as the public sector. So public sector infrastructure projects, public sector development spending needs to take resilience into account. whether it be in agriculture, whether it be in energy infrastructure, whether it be in roads or rail, transport infrastructure. But that also is important for the private sector. And what we would like to see, and what I will be discussing with the private sector gathered here, is their need to better understand their own risks from changing weather patterns and from climate and disaster risk. Just to put a couple of numbers on it, in the last 4 decades, climate and weather-related disasters have increased nearly 5-fold, and the economic losses have increased from around 150 billion in the 1970s to 850 billion in the last decade. And as the world advances, and as there is more built infrastructure and more people and more populous cities and pieces of the economy that are in harm's way from increased climate-induced weather disasters, so we can expect those numbers to continue to increase. East Asia and the Pacific is the hardest hit region. Between 2000 and 2011, more than 1.6 billion people have been affected by disasters, with the region sustaining some 300 billion in losses, or over 61% of the world's total losses, making it more than any other region. It's important for us in the World Bank Group that we're here in the Philippines. The Philippines, as you know, has been at the forefront of experimentation in finding ways to build its own financial resilience, contingent credit facilities, catastrophe risk assessments. These are all things which have been pioneered in this country. And together now with the Philippines government, we are trying to look at building a much more robust, comprehensive financial resilience system that would offer insurance and risk transfers at the national government, local government unit, and individual household level. I'd be happy to take any questions on that, but I'm glad to see that in the Cebu documents that the Philippines government has put the issue of resilience at the heart of the challenge of continued economic growth and prosperity for this region. And as one of the Philippines' partners, together with the private insurance industry and others who are very familiar with how to build financial resilience, we're glad to be here and glad that this has been put on the agenda by the Philippines government. Thank you.
Okay, thank you very much. We are now opening the floor to questions, but first, just a note to our friends from the media who would like to address some questions to Mr. Andre. I kindly request to limit your questions to a regional or global scale, as he may not have an expertise on the specifics about the Philippines. And again, as for our house rules, if you have questions, please raise your hand. Allow me to acknowledge you. Proceed to the mic, and please state your name and your affiliation. Okay, so who would like to ask the first question? Anyone? Okay, yes, Ben.
I'm Ben De Vera from Philippine Daily Inquirer. To Ms. Kyte, you mentioned that initiative. Can you elaborate on it, the one on insurance and covering local governments?
Do you want to take more than one question?
Ben, may you...
No, that just...
You want me to answer? Okay, thank you very much. So following the series of weather-related disasters that culminated in Haiyan, we've been in discussion with the Philippine government about ways in which we can improve the resilience, the financial resilience of the Philippines, building also on the previous history in the Philippines of using different financial instruments available to the Philippines in the multilateral development financial system. So the Philippines was the first country to take advantage of a contingent credit facility, often known as a Kyte DDO. And so building upon that, how does one both improve the amount of insurance that is available within the country at different levels, at the national level, at the local government level, and at the household level, in order to be able to build back better in the event of a disaster? But then also, how do you increase the liquidity in the financial system so that you are building resilience in advance of a disaster as well? And so trying to find ways to improve the financial protection has been a dialogue between us and the government, together with the private sector and other development actors, for the last 18 months. We've now taken some of the examples of the dialogue here in the Philippines to other countries. We're talking to countries as diverse as Colombia, Kenya, Laos, Panama, Peru and Vietnam about how to build financial protection strategies. And so the idea here in the Philippines is to create a new disaster risk financing strategy. This would this would supplement a $500 million line of credit, the Kyte DDO, which I've already referred to, and is looking at whether or not there is a possibility of a market-based catastrophe risk transfer transaction. At the local level, we're looking at how to establish catastrophe insurance facilities at local government level. This would be the first time, if it were possible, that you could establish catastrophe risk insurance at a sub-national level. And at the individual household level, our private sector arm, the International Finance Corporation, is working together with clients in the Philippines to see whether or not it is possible to establish a national catastrophe risk insurance pool for small, medium-sized enterprises and homeowners. So what I think is important to understand is that the Philippines needs to build its financial resilience. That is a priority for the country. There are different ways in which to do that. And this is a place where that conversation is happening. Experimentation is going to take place, and the rest of the world is watching what is happening in the Philippines in order to be able to replicate whatever moves forward and works here. These things don't happen overnight. And these things, we're talking about building a financial architecture that will be resilient. And so these things don't always move very fast. But this dialogue is very engaged, involves both private and public actors internationally in support of Philippine financial sector and the Philippine government. And hopefully you'll be able to hear news of progress from our Philippine counterparts in the months to come. Thank you.
Okay, yes, Sig.
Good afternoon, Siegfried Delegado of Bloomberg. Just a follow-up to Ms. Kyte. You said you're also in discussions about supplementing the $500 million DDO through various means, one of which is tapping the markets for possible catastrophe financing. I'm wondering what the type of catastrophe financing is this. Are you looking at catastrophe bonds, for example, and whether you think it's viable for a country like the Philippines to, to tap both the bond markets and other financial instruments in defraying costs of natural disasters to local governments and to individuals?
Thank you. So those are exactly the sensitivities and the stress testing of what would work best is exactly the process of technical work that's being undertaken at the moment by us and by others in the insurance markets together with the Philippine authorities. So understanding what instruments would be best, what has been the track record of catastrophe risk elsewhere in the world, whether or not it will work to build catastrophe risk facilities at the subnational level. So testing out all of this is the technical work that's going on at the moment. In the catastrophe risk world, I think there's been an evolution from its introduction first in the Caribbean and Central America and then in the Pacific, and now catastrophe risk facilities built up in Africa under the Africa Union. So we are seeing more and more jurisdictions build catastrophe risk pools for themselves and for their neighbours. And what we're seeing is that as countries become familiar with using catastrophe risk and familiar with what happens when one calls on that catastrophe risk pool facility, one understands how the regulation of one's own insurance sector may need to evolve, may need to mature. And so what we're seeing is just the experience of using catastrophe risk being an education for a government and for people and for the private sector in an economy in terms of how to think through how to build deeper and more liquid insurance markets. Now, of course, insurance is only one response. One has to build the resilience into the infrastructure and into the economy so that in a country like Philippines, where we know there will be predictable disasters, both geophysical and hydrometeorological, then we need to be building economies that will withstand those disasters as well as then be able to respond to them. And that's the second half of the work, is how does one do that? But you're raising all the right questions, and those require technical responses. And I'm sure when that technical work is finished, we'll be able to release that to the public.
Thank you. Who wants to ask the next question? Okay, okay, please.
I would just wish to make a comment about Philippines, because that's where we are. We can observe now that there is that investment and infrastructure, especially investment, is more and more a multi-stakeholder process. And it happened that there are some very good examples, good practices in some countries, and this is the case in Philippines. You have what is called the Philippine Investment Alliance for Infrastructure, PINAI, and that's an excellent example of an interesting process that you did develop with the government, with an ADB, and with the private sector. That's a Dutch company. And that's exactly the kind of thing which is more and more developed in countries, with the pooling of capital between the public and private side. And I think that's a very good example of the kind of development which will be promoted in the future.
Okay, perhaps while our media friends are still formulating some questions, may I take this opportunity to ask Mr. Laboul this interesting question. At these times of financial market volatility, how do we encourage fund managers or capital owners to focus on long term when these uncertainties make them just focus on short term?
Well, this is indeed an issue in the list of obstacles that we did identify. We have also this short-termism approach. Well, the best thing, if you have a private investor, you will look the return, you will look about the risk, and so you need to make the product appealing. An investor won't invest just for the pleasure of the government, or won't invest in green investment just because it is green. They need to have bankable product. So you need to attract them with products which can provide indeed a return, but also which can provide which can be secure. And that's why I insisted on this, on the fact that one of the most frequent issue which is raised by the private sector concerning investment infrastructure is really this regulatory certainty. So they really need to have this certainty, but also to have a visibility. The project pipeline is, for example, something which is key for them. And of course, they need to have the skill to do that. And concerning the institutional investors, this is a frequent issue for the pension funds. Quite often, the pension funds do not have the expertise, And that's why in some countries they are pooling themselves. For instance, in Australia, they're pooling themselves. So you have an organization which can 30 pension funds and which then can have the expertise to invest in infrastructure. And you need expertise to invest in infrastructure.
Okay, thank you. Do you have more questions from the floor? Okay, I would also ask one question for Ms. Kyte. The subject of disaster risk is not as sexy as other topics, such as the market volatility and even politics. So how do we encourage economies and governments to really focus on this issue?
Well, I happen to think that the kinds of numbers of people affected and the kinds of billions of dollars of losses that we're starting to see on an annual basis now worldwide. I don't know what your definition of sexy is, but I mean, that's pretty sexy for me. I mean, the science predicts that the incidence and the frequency and the intensity of weather-related climate-induced disasters is going to increase, and it will increase substantially over the next decade or two as a result of the warming that we've already predetermined by the behavior of the industrialized economies in previous years. That means that we now have to cope with that while we aggressively mitigate further emissions and while we understand how best to create that resilience. I think what economic leaders and political leaders perhaps need to understand better is that while the science is very clear, the economics are pretty compelling as well. And the economics indicate that it is much cheaper to act now than it will be to act later. So acting now to choose on the mitigation of emissions, a lower carbon option is going to be better, because if we continue to warm at this rate, then we will be having to adapt even more and more in the future and become resilient to more and more extreme weather events and other consequences of climate change. And if we invest now, even though it may be a little bit more expensive, then the resilience of that infrastructure, the resilience of that agricultural system, the resilience of that community will be improved, and that will drive economic growth. So, it's always difficult to make decisions to spend or invest when you perhaps don't feel that you absolutely must do. It's like buying life insurance. But all of the evidence is that this makes absolute sense, which is why we, in all of our investments, now screen for climate and disaster risk. It's why on the climate scenarios of the science that is there, which shows you that roads that used to have to be built to withstand temperatures of 42 degrees centigrade may now have to be built to withstand temperatures of 52 degrees, which means different techniques, different building methods, different building materials, and perhaps more cost. And that's just one example. It means you might need to buy different kinds of seed. It may mean you have to plant differently. It may mean that you need to restore irrigation systems, and that investing in that now will help communities bounce back after a storm rather than see their irrigation systems collapse for months on end and have to rely on public expenditure to survive. So spending now will save later, and that's often a difficult public policy expenditure decision to make, but all of the evidence is that is the case.
Okay, do we have any more questions from the floor? Okay, please.
Good afternoon, I'm Jean Antiporta, DYM Araja ng Bayan. I'd like to address my question to Sir Andre. In the APEC economies, there is still a significant need for infrastructure. Do you agree with the proponents of the Cebu Action Plan that mechanisms must be developed to match available capital with infrastructure needs?
To match available capital with infrastructure need. That's what you say? Of course, but and also in this respect, I would wish to expand a little bit on something related to corporate financing. We made a survey at the OECD on 10,000 companies, and clearly these companies have a lot of cash, but the cash is not going to investment, and that's a big issue for the corporate financing, because for their own investment they have sufficient cash. There is no shortage of capital in this kind of thing. The problem is that the capital is not going to the investment, to the right investment, and that's we back to the question raised by our moderator and the need to have really bankable product. Concerning indeed the region and especially the Asian region, when you see the figures which has been provided, there's huge needs. But that's not only infrastructure, in the big sense. That's not only the road, but that's also the sanitation. That's this is all this kind of thing which is important. The access to the water and to the electricity for the people. So there are huge needs for infrastructure, obviously, and something has to be done and to be done urgently. And this investment will be an investment also for growth. Infrastructure investment are really, really, really conducive to growth, to job creation, to productivity. So that's why this region has to make a special effort for this kind of investment.
Thank you. Yes, please.
Good evening. I'm Mikhail Flores of Business World. This question is addressed to Mr. Andre. In terms of infrastructure financing, I think OECD in the past has suggested tapping insurance, pension funds, and assets under management as a way to finance infrastructure projects. How would you assess so far the reception of these potential sources of financing in terms of their own capital flowing into infrastructure, and what are your prescriptions in terms of for the government and and regulators in terms of developing a framework in which pension funds and insurers and the like would be more interested in investing in infrastructure projects? Thank you.
Yes, thank you for your question. Yes, indeed. We developed quite a lot of work on these two important institutional investors, the pension funds, the life insurance companies. They are typically natural long-term investors because of the asset liability structure. And as I just said, we observe that they do not invest a lot in direct infrastructure, less than 1% on average of the investment. And this is explained by a lot of factors, but one of them is really the issues related to their own skill and their awareness and also willingness to go into that field. It happened that I'm also the Secretary General of an international organization called the IOPS. This is the International Organization of Pension Supervisors. And I can tell you that supervisors they will not necessarily push the pension fund to invest in infrastructure because infrastructure can be quite risky. And one of the risks is, of course, related to the illiquidity of the investment, but also the fact, and again, I insist on that, the fact that you need to know and you need to be able to manage, if you do it yourself, of course. Otherwise, usually a lot of pension funds are also using the services of financial intermediaries, but they're not very happy about that because usually the fees are very high, extremely high, and this is also why we observe now that there is a trend for the pension fund to begin to invest directly, but also to do that in a pooling, to pool with some other pension funds, or even to have. There are very interesting initiatives. There is one in Europe when you have an insurance company which join force with a bank. and both are investing in infrastructure. So the insurance companies give the funds, in one sense, the banks has the expertise, and this joint approach is something which has been which is quite beneficial.
Can I just
Sure.
add in that as Andre said, there are many reasons. There are many reasons why long-term investors or so-called long-term investors don't invest directly in infrastructure, and one of those, and there are many attempts to address each of those reasons. But one of those is also the inability of a classic asset owner, a European pension fund, for example, to actually have what you would call boots on the ground, to actually be on the ground in emerging markets, in developing countries, and to make sure that that direct investment in an infrastructure project is going to be well executed, because of course they have the ultimate fiduciary responsibility to the ultimate beneficiary. So one experiment which I think is proving to be quite successful is the asset management company of the International Finance Corporation, where on a pari passu basis, long-term investors, pension funds, institutional investors are coming in and investing alongside, basing their preparedness to invest in different funds on the origination capacity, the due diligence, etc., of a AAA-rated institution such as the IFC. So I think that you're going to see more and more of these kinds of hybrids coming forward. Now the question is, are they going to come forward quickly enough and big enough to bridge this eternal gap between the growing infrastructure needs and this capital, which is not in short supply, just not moving to where it's needed at the moment?
Yes, and I remind you also that basically the institutional investors, that's $90 trillion. So that's very huge, huh? And this could benefit really to the infrastructure investment.
Okay, I can accommodate one more question if there is still one. None? Okay, for our closing, may I ask our speakers, because for this 3-day meeting here in Cebu, the top agenda is the Cebu Action Plan. And so to close this press conference, may I ask you to share your views on the importance of the Cebu Action Plan in terms of pursuing the goal of resilience and long-term investments?
Well, as I said in my opening statement, I think it's important that the Philippine government put resilience into an action plan. Any plan for growth, prosperity, jobs, competitiveness in this region is going to have to take account of the fact that this region is disproportionately affected by disasters, including those disasters spurred by climate change, that many of the economies in APEC and in this region are vulnerable, highly vulnerable, and we're working with the Philippine government on how to organize vulnerable economies so that their voices are better heard in the international system, and that this is a necessary, unfortunately, part of the future growth. You know, we now need to build a growth which is low in carbon and resilient, and putting that at the heart of the Cebu Action Plan is an essential first step of leadership shown by the Philippine government.
Yeah, just to add very briefly, because I mentioned that at the beginning, I think that first this is an excellent initiative to have a plan which is a long-term plan. That's important because it provides really direction, and also it will certainly provide a way to assess how the work is developed. Because that's quite important also when you have an organization like the APEC, G20, or whatever organization to assess themselves. At some point to say, okay, we did commit or we did decide to launch this kind of initiative. Now, where are we? Did we deliver? And that's a responsibility also of the government to do that. And I really think, and as I said at the beginning, that this Cebu Action Plan is something very promising. Of course, the name Cebu will be there forever, so that's good for Philippines. And of course, all the IOs, the World Bank, and IMF, and the MDBs and OECD, of course, will be there also to support the APEC economies. We, OECD, are, for instance, especially interested, but that's exactly the same for the World Bank. I know at least for a significant part of that. We're especially interested in supporting the work for disaster risk financing, for investment infrastructure, and also financial inclusion. Financial inclusion is also an important component of the work of APEC, and even more than G20. And I think this is something which is really, really welcome. Financial inclusion, financial education, financial consumer protection. That's something which is extremely important also for the region. And that's, again, something which will allow also certainly to facilitate also the growth of the countries.
Okay, so that ends this round of press conference. Thank you very much to Mr. Rachel Kyte and to Mr. Andre Laboul and to our media friends. To our media friends, we have another round, last round of press conference at 6 o'clock with the BSP Deputy Governor Nestor Espinilla Jr. So please stand by for that. Thank you.